Welcome to This Explainer. Okay, today we're popping the hood on corporate finance. Now, I know what you're thinking. Financial management? You're probably picturing dry math, endless spreadsheets, and rigid rules. Well, let's completely scrap that. I want you to look at it not as a giant calculator, but as a living, breathing circulatory system, the absolute lifeblood of any thriving business organism. Without a steady, healthy flow of capital, even the most innovative company is going to wither. To really get a grip on this organism, here's our roadmap for today. We're going to cover the lifeblood of business, the anatomy of financial health, managing the day-to-day, investing in the future, and finally, finding the funds.
All right, let's dive straight into Section 1, the lifeblood of business, and how funds actually flow through a corporate ecosystem. Think about it. To survive, businesses absolutely depend on the continuous circulation of money. At its very core, financial management is basically the brain of the operation. It's all about making sure a business has enough money, using it wisely, and keeping the whole organization financially healthy by meticulously managing those inflows and outflows. It's the critical system that allocates the vital resources a business needs, not just for basic day-to-day survival, but for serious long-term growth.
And it's so important to realize that financial management does not operate in a vacuum. In fact, it sits right at the center, actively supporting and being shaped by literally every other department. Marketing needs their ad budgets evaluated for ROI. Operations, they need financing for heavy machinery. HR relies on it for salaries and payroll planning, and it's constantly reacting to outside forces too. Stuff like inflation, changing political regulations, tech leaps, and even societal shifts.
Which brings us to Section 2, Anatomy of Financial Health. We're looking at the structural organs of a business here.
So, our ultimate long-term goal is always to increase business value while keeping the cost of capital as low as possible. To see if we're actually doing that, we use the Statement of Financial Position. Think of this as the ultimate medical checkup for a company. It gives us a precise snapshot at one specific moment in time, showing exactly what a business owns, what it owes to others, and the remaining value that actually belongs to the owners. And to really read this, we just need to understand two key components: assets and liabilities.
Let's start with what the business owns, its assets. We generally split these into two camps. On one side, we've got current assets. This is your short-term lifeblood, stuff like cash and inventory that you expect to convert into cash within a year to fund those day-to-day operations. On the flip side, we have non-current assets. These are your long-term structural organs. We're talking factories, heavy machinery, vehicles, things owned and used for way over a year to generate revenue, definitely not intended for a quick sale.
Now, generating income from those assets obviously requires some sacrifice, right? We measure that as costs. Just like our own personal bank accounts, a business has fixed and variable costs. Fixed costs are kind of like your monthly rent. They stay totally unchanged whether you're producing a little or a lot, up to a certain capacity. Variable costs, though, those are more like your grocery bills. They change directly depending on the volume you produce, or in my case, how hungry I am at the store. Combine those two, and boom, you've got your total cost of production.
So, what happens when the income you earn exceeds those total costs? Well, the business generates a profit. The value left over, the part financed by the owners rather than external lenders, is called equity, or shareholders' interest. The really massive decision management faces at this point is what to actually do with that profit. Do they distribute it out, or do they reinvest it back into the business? That whole process is known as the return of proceeds to shareholders.
So the crucial point here is that a healthy business is constantly performing a massive balancing act. It has to maintain profitability, meaning making money above its costs. It absolutely must maintain liquidity, being able to actually pay today's bills as they become due. And it has to maintain solvency, making sure those structural assets comfortably and consistently exceed liabilities.
Which leads us perfectly into Section 3, Managing the Day-to-Day, or the daily pulse of working capital.
All right, so we're shifting gears from that big structural checkup down to the frantic, short-term reality of managing daily funds. Working capital management is exactly how a business handles its cash, its stock, the money owed by customers, and its own short-term debts. The whole goal is just ensuring it can pay the bills and keep things running smoothly. Now, every business has a permanent baseline need for working capital, but honestly, it fluctuates wildly based on things like seasonal trends or sudden shifts in production.
And managing this creates a totally ruthless balancing act for financial managers when it comes to cash. You see, holding too much cash is actually a huge problem. I mean, as fun as it sounds to swim in a money bin like Scrooge McDuck, you're losing out on potential interest, and inflation just eats away your purchasing power over time. But on the other hand, holding too little cash, incredibly dangerous. You risk losing goodwill with your suppliers, missing out on discounts, blowing past opportunities, and having to take on really costly borrowing just to keep the lights on. It's a tightrope walk to find the optimal trade-off between liquidity risk and the cost of being too liquid.
A massive chunk of this daily management also involves debtors, the people who owe the business money. Whenever a business extends credit terms, they have to carefully evaluate the 4 C's of credit to make sure they'll actually collect the cash they need to survive. They've got to look at character. Is the customer actually willing to pay? Capacity. Do they have the real ability to pay? Capital. What are their underlying financial resources? And finally, conditions. What does the current economic environment around them look like right now?
Okay, so we know how to pay today's bills and chase down today's debts, but seriously, how on earth does a business plan for the next 30 years?
That takes us straight into Section 4, Investing in the Future. We're talking capital budgeting and the time value of money.
We are officially zooming out. We're moving from the daily hustle to the slow, highly deliberate world of strategic, long-term decision-making. This process is called capital budgeting. It's how a business decides which long-term investments are actually worth dumping massive amounts of money into. We are talking about projects that might accrue benefits for 30, maybe even 40 years. The strategic magnitude of this is absolutely off the charts. Whether it's developing a brand new product, rolling out new tech, or expanding internationally, it requires formal budgets mapping out future actions down to the exact dollar.
Now, what's really fascinating here is the core concept behind all these massive decisions, the time value of money. Think about the relationship going on here. Time, the amount of cash involved, and the opportunity to earn interest basically dictate everything. If you invest present value, it compounds into the future. But conversely, you have to discount future value back to the present just to see if a 30-year project is even worth starting today. But here is the multi-million-dollar question. To fund those daily operations and those massive 30-year projects, where exactly does all this capital actually come from?
Welcome to Section 5, Finding the Funds and Securing the Resources to Survive and Grow.
Let's walk through the 3-step life cycle of a dollar as it enters, works, and gets tracked within the corporate organism. This is the core financial function. Step 1, acquisition of funds. This means securing the money by taking out loans or issuing shares. Step 2, application of funds. This is putting that cash to work, buying assets, allocating it to expenses. And finally, Step 3, administration and reporting. This means keeping incredibly precise records, evaluating performance, and communicating those results clearly to management and shareholders.
Now, the toolkit financial managers use to actually acquire these funds is pretty huge. It ranges from quick patches to massive commitments. For short-term needs, they might rely on trade credit, accruals, bank overdrafts, or factoring. But for the long haul, they look at long-term equity. That includes owner's equity like share capital and retained profit, or preference shares. They'll also use long-term debt, locking in loans and credit that take a year or more to mature. And, very often, they'll tap right into secondary financial markets just to trade these negotiable securities.
Getting this financing right is just absolutely vital, especially when the outside environment gets chaotic. As the source material points out, a healthy supply chain also needs a smooth cash flow to align incentives and streamline sales and procurement. When supply is volatile and finance costs are sky-high, effectively managing trade financing isn't just a nice-to-have. It is absolutely critical to keeping physical goods moving all across the globe.
Let's move on and see how this all builds into the concept of capital structure. Think of this as the grand architectural blueprint. It shows exactly how a business gets the money it needs for long-term operations. Specifically, it's the balance between debt, which is borrowed money that obviously carries risk, and equity, which is the owner's own money. Finding that perfect sweet spot equilibrium between the risk of debt and the ownership of equity, that is, without a doubt, the ultimate test of a financial manager's skill.
So we've covered the ecosystem, the anatomy, the daily pulse, and the long-term future of corporate finance. Every single concept we've looked at today is a vital organ in the body of a successful organization. So as we wrap up this explainer, I want to leave you with a challenge. Try applying these concepts to your own ventures or the company you work for. Ask yourself, is your business generating enough lifeblood to truly thrive, or is it just surviving? Keep analyzing, keep learning, and I'll catch you in the next explainer.